we have the same concept for the buyers, right? Buyers, let's say a refinery is gonna need crude oil as the raw material, right? So because a buyer is always short in the in the cash market, they have to take the opposite position in the financial market, which is the long position, and that's why it is called long hedge, right? Okay, let's work on an example. Same example. Let's say you work for a refinery. Right now it's March. The price in the spot market is $60 spot market. Financial market delivering in December is $61. Time passes, early November, prices go down. Prices go down 70 cents in each market, the spot market and financial market. We set up our table. This is the table, and let's calculate how much do we make or lose in the cash market or financial market. So as a refinery, you are buyer, right? So it's, if price go down, you aim for 60, right now it's 70 cents less. So you end up paying less money. So you actually make money. How much? The difference between these two times the quantity of oil, the volume of oil that you will need. How much? It is going to be the difference times 500,000 barrels. So you are going to end up making 350,000 barrels of crude, $350,000 because you took a long position in March, right? And you have to close your position early November. Prices go down, position was long. From fundamental factor, we know that if you take a long position, if market is bearish, if prices go down, you lose money because you buy high, you sell low, right? How much? Minus $350,000. And again, under this scenario, you see that if there was no hedging, we could have made $350,000. But because we hedge, we are obligated under these futures contract, we have to close the position. When we close, we lose money in closing. But when it's March, you don't know what is going to happen in December. So you say, okay, you know what? I'm going to get rid of potential loss and potential profit. In this case, you get rid of potential revenue. If you know for sure market is going to be bearish, then you should not get involved in any hedging, right? Okay, the other example, assuming that the market is going to be bullish, so prices go up 50 cents in each market. We'll set up the table. March, spot market $60, futures market December $61. Then time passes, prices go up, market is bullish, 50 cents in each market. We end up losing money in the cash market because we planned for $60. Then prices go up. We need to buy at higher price. So we lose $250,000 in the cash market. Financial market, what happens? We took a long position, 500, market is bullish. So long position, bullish market makes money. How much? The difference times the contracts that we have. We have 500 contracts, 1,000 barrels each. It is going to be 500,000 barrels times the difference. So we'll make $250,000. And as you can see, the net here is zero. What we make in one market cancels out whatever we lose in the other market. Here, hedging is perfect. So we were covered. We made some money that covered some of the expenses, extra expenses that we had in the cash market. Okay, so this was perfect hedge when gain and loss in one market eliminates gain and loss and gain in the other market. This is a bit, in reality, they don't exactly, they are, spot market and financial market are highly correlated, but the changes are not exactly the same. You see here 50 cents, here 50 cents. These are not exactly 50 cents. So in that case, what creates the situation is going to be called imperfect hedge. Everything else is very similar to here. Hedging strategy is very similar, but the net is not going to be zero because the change is not exactly the same. Still, they are hardly correlated. It's still, if one goes up, the other goes up. One goes down, the other goes down, but not exactly the same amount.